Welcome to S&P's European Loan Market Video Overview, detailing leveraged finance trends and activity during December 2012. I'm Suchit Gupta, a member of S&P Capital IQ's Leveraged Finance Commentary and Data Team, a unit of S&P that is not affiliated with S&P Ratings. For the next few minutes, I'll walk you through a review of recent loan and high-yield bond market trends in Europe, before winding up with themes to watch for in December and early January 2013. Before we start, please know you can follow LCD on Twitter, Facebook, and can join the almost 9,500 contacts in LCD's Leveraged Loan Group on LinkedIn, as well as leveragedloan.com, a free website promoting the loan asset class. We're pleased to announce the launch of highyieldbond.com, a free website promoting the high-yield asset class. On it, you'll find recent market stats, news and analysis, high-yield and leveraged finance job postings, and an online primer that explains key market terms. The links to our new website and to follow LCD's social channels are in the info section on our YouTube channel. You can also download the slides for this video at slideshare.net. For November 2012, loan issuance shot up to 4.3 billion euros, up from 3.7 billion the prior month. High-yield issuance came down at 3.4 billion euros, down from 3.5 billion seen in October 2012. According to JP Morgan High Yield Research, estimated inflows into high yield funds was 536 million for November. This brings the year-to-date number through the end of November to almost 6 billion euros. Secondary markets are up. Loan markets went up 48 bips to finish the month at 96.83, while high yield markets are up 84 bips to finish the month at par and 81. The S&P European Leveraged Loan Index, the LE, finished the month up 0.66% till the week ending November 29th. Default rates stabilized during the month. Focusing on the secondary loan market, this chart details the average price of LCD's European Loan Flow Name Composite, a measure of the 12 largest, most liquid loans consisting of 10 issuers since 2002. Even with the busy primary market, secondary loan prices rose 48 bips to finish the month at 96.83. Year-to-date, loan prices have risen 279 bips. This next chart details the average price of LCD's European High Yield Flow Name Composite, a measure of the 12 most liquid high-yield issues since the beginning of the year 2010. The high-yield market finished the month at 100.81 or par 81, up 84 bips for the month. Year-to-date, high-yield bond prices have risen almost 11 points or 1,103 basis points for the year. This chart details the monthly return of the LE, a broad measure of European loan market returns that LCD calculates. All returns are ex-currency unless otherwise stated. The European loan market had a positive return of 0.66% for the month of November. This is up till the week ending November 29th, up from 0.47% seen in October 2012. The total LE return for the first 11 months of 2012 is a positive 8.7% versus a positive 0.71% for the same period last year. Now we turn from the secondary to the primary. This graph details new issue volume for both leveraged loans and high-yield bonds. November saw European monthly loan volume jump up to 4.3 billion euros from 15 transactions. This is a 6-month high. Year-to-date new issuance for leveraged loans through the end of November 2012 was 29.8 billion euros, down 34% from the same period 2011. Sponsored transactions generated 23.3 billion of leveraged loans, down 30% from the same period in 2011. However, buyout activity has fallen by a greater margin, down almost 37% to 11.6 billion euros between January and November 2012. This is its lowest level since 2009. The decline in traditional buyout activity is discouraging. For the first time since LCD started tracking the European leveraged loan market in 1998, less than half of all loans, 49.7%, raised by sponsors went towards buyouts. This is down from 54.2% in 2011 and roughly 75% between 2008 and 2010. Instead, European borrowers took advantage of European liquid market conditions to reduce interest rate costs, improve their maturity profile, and pay a dividend to owners or achieve various combinations of these objectives. As a result, 57% of leveraged loans launched in the last 2 months funded a recapitalization or refinanced existing debt, up from 41% between January and September. This equates to 4.6 billion euros of paper, already exceeding the refinancing recap tally from any quarter in 2012. High-yield bond issuance was 3.4 billion euros, down from the 3.5 billion seen in October 2012. While September's 7.2 billion euros issuance remains the busiest month so far this year, October and November accounted for the third and fourth highest readings so far in 2012. Indeed, the healthy showing in the last 3 months pushed the year-to-date volume to 34.8 billion euros, 2% behind the 35.7 billion euros tracked in the full year 2011. European borrowers made progress at chipping away their near-term maturity wall. In the year to September 27, 2012, the par amount of institutional facilities due through the end of 2014 fell by 61% to just 11.2 billion euros, and the amount due through the end of 2015 fell by 36% to 40.5 billion euros, according to the S&P European Leveraged Loan Index, the LE. As a result, in the last 9 months, the index has moved between slightly skewed in favor of near-term maturities, with 56% falling due through 2015, to being significantly skewed towards longer-term maturities, with 63% falling due in 2016 or later. In November, the bond for loan market trend showed little signs of slowing down, as 4 companies tapped the high-yield bond market for this purpose, raising 1.2 billion euros in total. Since the end of the third quarter, 16% of new issue volume went solely towards replacing bank debt, close to 18% between January and September 2012. The default rate by principal amount stayed the same at 6.3% at the end of November 2012, as no new defaults occurred. This also kept the default rate by issuer count at 8% at the end of November 2012. Themes to watch for going forward. No significant changes to the quantitative easing policies from the ECB. A flurry of activity before the year end, otherwise deals are going to get pushed into the new year. Given the strong inflows in the European high-yield bond market funds, bond for loan takeouts will continue to keep pace. Peripheral issuers from Eurozone peripheral countries will continue to access the high-yield markets. Issuers will seek to add on facilities instead of whole new facilities for their transactional needs, and this is in regards to loan facilities in particular. European issuers will increasingly go across the pond to the US to issue loans and bonds, given the greater depth and liquidity in those markets. Sell-side bankers and sponsors are optimistic about M&A activity during the first quarter of 2013, as sponsors try to exit some of their businesses that they entered in 2007-2006. And the big theme going forward into 2013 will be the loss of CLOs, as almost 85% of CLOs will be past their reinvestment periods at the end of 2013. That brings us to the end of our overview. I hope you found it informative. We'll update the analysis each month and plan to have analysis of other specific European market segments going forward. Check out LCD's YouTube page for the other video analysis of the leveraged finance market, including U.S. loan market wrap-ups. The link to the page is in the description for this video. For more information on LCD news or research in Europe, you can contact Anna Cini. You can email her by clicking on the link in the info box. Thanks very much. We'll see you soon.